Hi and welcome to Swissquote's Daily Market Talk. It's Friday, June 13th. Israel attacks Iranian nuclear facilities. Iran sends hundreds of drones on Israel. Oil jumps, the US dollar and safe haven assets rally as equities come under pressure this morning. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the big story of this morning is oil that jumped as much as 13% as Israel launched a major and an unprecedented attack on Iran targeting their nuclear and military facilities. Now, the news don't come as a surprise, obviously, because, there were reports out there throughout this week that Israel was preparing to do something in Iran, and the US actually ordered Americans to leave the region this week. But the Israeli attacks could be the beginning of wider tensions in the region, say some people out there. So if Israel starts going beyond its borders, the Middle East could boil fast. So Israel says that Iranian nuclear program is an existential threat to them and that their operation will continue as long as it is necessary, and we believe them, while Iran already launched hundreds of drones in retaliation and could do more. But the question is, how much more? Because back in October 2024, remember, Israel had already launched a major strike on Iranian nuclear facilities. And by then, Iran had actually chosen to respond with drone attacks that have been mostly diverted and were mostly perceived by the world as a warning rather than retaliation and full war. And the tensions had eased right after that and the markets had rapidly settled. So it's possible that we see similar de-escalation this time around as well, but the possibility of broader tensions in the Middle East could not be ruled out. And looking at the price action in the markets, while the market's response, the market's reaction to last night's attacks was indeed very strong. So the barrel of US crude jumped as much as 13%, as I said earlier in this episode, and traded past the $77 per barrel level in the early hours of trading, while Brent traded past the $76 per barrel level. Now, there is a certain pullback in prices this morning at the time I'm talking here, but tensions are not over just yet. Now, one scenario is de-escalation, obviously, and return of the price of a barrel below the $70 per barrel mark with attention back on supply and demand dynamics, trade disruption, and renewed pressure on Russian oil, maybe on the geopolitical front. The other scenario is a broader escalation of the tensions in the Middle East, which could then push the barrel of oil toward the $90 to $100 per barrel range, hopefully temporarily. And beyond oil, if the tensions in the Middle East result in disruptions in the Strait of Hormuz, LNG flows could also take a hit, as 1/5 of the LNG transits the strait in the world. So for now, there is no major price action happening on that front, so let's hope that the tensions in the Middle East wane before a broader impact is seen. Now, note that the US and Iran are supposed to meet in Oman this Sunday to talk about Iranian nuclear program. So the weekend, the next 48 to 72 hours could bring further news. Now, of course, the rising geopolitical tensions in the Middle East are powering safe haven assets, with gold trading 1% higher at the time I'm talking here this morning. That's a touch below its all-time high level, while the dollar franc is flirting with the 80 cents level despite a broadly stronger US dollar across the board today. Note, however, that the US dollar rebounds after having hit its lowest level since April 2022 on the back of another set of soft inflation data released yesterday in the US, which actually showed that the producer prices in the United States also increased slower than expected by analysts in the month of May. So in summary, this week's softer than expected inflation figures from the US soothed worries that the US inflation will be exploding in response to tariffs. So the US 2-year yield slipped below the 3.90% mark on rising dovish Fed expectations, but still note that activity on Fed funds futures still see the chance of a July rate cut by less than 30%. Now, looking at the longer term papers, the US 10-year papers are amassing safe haven flows this morning, while the 30-year papers also see demand, especially after yesterday's $22 billion auction saw strong demand, suggesting that the US debt worries have been well digested by investors. That means America can continue to spend, it could continue to spend big, and we will finance, says international investors. What a wonderful world, what a good place to be, right? So soft inflation and lower yields gave support to US equities yesterday, but the futures are obviously deeply in the negative this morning at the time I'm talking here. Oil and defense stocks will certainly get a boost on rising geopolitical tensions today, but the rest of the market should remain under the pressure of the rising geopolitical tensions. Now, if you look beyond geopolitical tensions and the risk off mode of this morning, equity valuations in the US look relatively high, as you doubt, especially compared with the bond returns, the so-called equity premium. So the difference between equity and treasury returns has fallen to the lowest level since 2002 for the S&P 500 stocks and is now negative. It means that at the current prices for the S&P 500 stocks, you have a better return by investing in US Treasuries than in the S&P 500 stocks that currently return 3.60%. So the relatively low return on the S&P 500 stocks is obviously partly explained by the relentless rally that we see in the S&P 500's big technology stocks, and partly due to the US yields that actually reached the highest levels in decades over the past few weeks of trading. So of course, if you pull the Magnificent Seven stocks out of the S&P 500, the S&P 493 yields around 5%. So that's a little bit better, but even then, these stocks offer a minor risk premium compared to US Treasuries that are supposed to be low risk. Now, how low risk is open to discussion, obviously, but history shows that the US has always been able to make the markets eat its debt. So it's quite low risk still. On the other hand, a gauge of insider sentiment hints that insiders in companies, so insiders are people like directors, managers, and other people inside the companies who have a better knowledge of the underlying business fundamentals. So these people, these insiders, rather prefer to sell their shares at the current prices rather than buying them. Now, according to data collected by Washington Service, over nearly 1,000 company insiders that participated in a survey, 200 of them bought shares of their companies this month, while 778 of them preferred to sell their shares. So we already talked about the fact that the big money managers and institutional players out there also remain on the sidelines and quite underweight equities, and that the latest rally that we see in equity prices was mostly driven and supported by the retail demand, which actually makes it fragile to speculation and fragile altogether. And potentially worsening geopolitical picture in the Middle East could then tame a part of this recent positive trade. So let's see what happens and what the weekend brings. But I believe that many investors out there, retail or institutional, will be willing to take risk off the table before walking into the weekend, which could eventually see Middle East tensions increase. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.